Hi, everyone. This is Jeff Praisman with Interactive Brokers. It's my pleasure to welcome back for our monthly webinar series with Market Chameleon, Dimitri Pagamatic and Will McBride. Hey, guys, how are you?
Hey, Jeff, how are you doing?
Hey, Jeff, how you doing? Sorry about the camera. We're having a little technical issue here.
Oh, no worries at all. It's great to have you guys back for our second Tuesday every month that we do these webinars. And then you guys swing by the ibkr podcast studio to do I guess, a different dive into the same subject. So I highly recommend everyone here to look for that podcast. Once we record it, should be released later in the week. So Dimitri and Will, what are you guys going to talk about today?
Yep, so we're going to talk about calendar spreads and how to screen for calendar spreads using different parameters and different conditions. And before we get into an example, what we'll do is look through this slide, quickly define calendar spreads and certain aspects of calendar spreads that are important before we do an example screen. And right now, I just want to bring up the disclosure, give you a chance to everybody to look at it. And while you're looking at it, what we're going to do is go through the slide. Then we're going to go do some example screens, and then we're going to leave 20 minutes at the end of the webinar just to take questions from the audience. And you could type those questions in that chat. And I think, Will, you're there, you're keeping an eye on it, and you'll read them back to me, once we get to the end of the webinar.
Yeah, perfect. I know, Jeff, one question we consistently get is if someone has to leave, how do they get access to the webinar?
Yeah, no, great question. So for anyone who has registered for this webinar, whether they're here right now live or they weren't able to make it at all or they leave early, if you have registered for this webinar, you will receive an email later in the day with a link to the recording. So whether you want to watch it again or whether you had to step out or you got busy with work, you'll get that link, or you just didn't make it, you had something going on, you'll get that link at the end of the day. You'll be able to click on it and see it. Also on our website, interactivebrokers.com, you can go to education, click on webinars, look for previously aired, and you can see all our past webinars, not only with Market Chameleon, but our other contributors as well. And you'll be able to get access to this. So everything's recorded and you can always see it at any time. Other item is that for the deck that Dimitri's showing, you can download your own copy if you go to the handout box of the part of the chat box, and also type in your questions, and the Market Chameleon will get to it toward the end of the webinar to answer any questions you have.
Now, everyone who's registered for the webinar, will they also be notified when the podcast is released?
No. So the podcast will come out. It'll be in our newsletter. It's sort of a different source of entries that get the notification, but they can go to our website, go to podcast, and they'll see it. I'll also kind of promote it on LinkedIn as well, and they'll be able to get to it. So I would expect, we'll record it tonight. I would expect it to come out most likely tomorrow night, or more likely Thursday at some point during the day.
All right, perfect. Let's go, D.
All right, thanks, Jeff. Thanks, Will. So in this slide, what we'll do is quickly do an overview of calendar spreads. We'll talk about what is the outlook in this particular strategy. So when you're doing a calendar spread, you're doing it because you have a certain outlook going forward. We'll discuss that. How do you set up this strategy? There are two legs involved. How do you actually set up a calendar spread? We'll talk about the profit and loss analysis in a calendar spread, because it's a little bit trickier than something like a vertical spread or just a simple option. We'll talk about valuation methods, and that becomes important because if you're a trader and you're using financial models and looking at valuations to compare it to market prices, well, how do we do that with calendar spreads? We'll talk about the difference between choosing at the money and out of the money strikes. How does that play into setting up a calendar spread? We'll talk about some of the risks associated with calendar spreads, and then we're going to move on to our examples. So let's start out with the outlook. And when we do a calendar spread, you could have a somewhat directional bias to the calendar spread, or you might just be neutral where you think it's going to stay right around where the stock is now. So you can set it up with some directional bias. When you're long a calendar spread, you could be long or short calendar spread, but let's just review the long calendar spread. The short will be the opposite side of this. Long calendar spread has a positive vega, and that means that you're looking for the implied volatility to increase in the longer dated option that you are long. You have one long, you have one short, so you're really looking for implied volatility increase in the one that you're long. And you're also have a horizontal implied volatility skew. Because you're doing two separate options, you're selling one option in one expiration, you're buying another option in a different expiration. Well, the implied volatilities could be different. One could be higher than the other, and typically they're not the same. And what options have is similar to a vertical skew where the implied volatilities are different by strike. Well, you have a horizontal skew where the implied volatilities change based on days to expiration. So that's something to keep in mind, where you could have an opinion about the current implied volatility skew, horizontal implied volatility skew, and that's another factor that goes into your unique forward-looking outlook. To set up this strategy, one is you have to, it involves buying one option at one expiration, selling an option in a different expiration with the same strike. So when we think of vertical skews, same expiration, different strikes. This is same strike, different expirations. That's why it's a calendar spread. You're doing the time difference. And our examples, we're going to look at a long calendar spread. So the long calendar spread means you're buying the longer term option and selling the shorter term option on the same strike. Okay. To the profit and loss at expiration, when we look at option profit calculators, usually we take a look at it. Well, what is the potential profit and loss at expiration? You know, if the stock is here, here, or here. And when you do that for strategy that involves options that all expire on the same expiration, it's a little bit easier to calculate because the option is either out of the money and worth is zero, or the option is in the money and it'll be worth whatever its intrinsic value is, the difference between the strike and stock price. But in a situation where we have two different expirations, we can't do that, because when the shorter term option expires, we still have another option that will expire at a future date. That means that option is not, it's going to have time premium. It's not just worth zero or its intrinsic value. It will have time premium, and that time premium could vary greatly because it will depend on what the implied volatility of that option is at that time. So it's trickier to calculate a profit and loss in this calendar spread. So to do that, we run an estimate, okay? And the estimate is based on when that first option expires, because when the first option expires, the one with less days to expiration, that option will be either worthless or it will be in the money. So we'll know at different stock prices what that option would be worth. And at that time, the calendar spread ceases to exist because it's no longer a calendar spread. Once that first option expires, either you're going to be left with just one option. If the first option expires worthless, you'll only be left with an option that still has days to expiration, or if that option is in the money, you'll get, if you do nothing, gets converted to stock, and then you have an option in the stock position, but it's no longer a calendar spread. So we look at the first expiration, and then what we do is say, okay, we know what the first option will be worth. We could draw the payout diagram for that on different stock prices, potential stock prices. For the second option, we give it an estimate based on an implied volatility that we estimate that implied volatility based on historical observations for similar options. So if that option has 15 days to go, we look at historically, what does an option like this look like with 15 days to go? And here, I guess I talked about this already just now, but when we do the profit and loss, the reason we use that first expiration is because that once that first expiration and that first option expires, it no longer is a calendar spread. So that's why you can't wait till the second expiration to run a profit and loss, right? Because it ceases to be a calendar spread once that first option expires. And here we talked about the implied volatility of the longer dated option, because we don't know what it will be. There's no knowing in the future what the implied volatility of that option will be. We need some kind of estimate or starting point. So in our case, we take the median implied volatility, the implied volatility where, if we look at all the historical observations that we captured, we say, okay, well, half the implied volatilities are above this amount, half are below. So we'll use that as our starting point estimator to calculate the potential profit and loss of this strategy. And another important, so that's trying to calculate the potential, risk and reward. Calculating the valuation, what do we think the value of this spread is worth, also is tricky, because we have two different expirations. So what are the implied volatilities that we assign them? Because there's still a relationship between them, but the implied volatilities could be different, which could be normal. So to help us with that, we could look at the historical observations for similar options. Let's say we have an option 15 days to go and 30 days to go, right? So we could look at that similar situation and see what is the implied volatility look like for those options, and what is the usual differences between them. So this way we could create a valuation benchmark, and how far away are we? All right, so think of it as like this long-term average value, and how far are we away from that long-term average value for this particular strategy. And this helps us with a horizontal skew, because the implied volatility term structure will move around. Right? It could get inverted. It could be sloping up. It could be sloping down. It could be flat at times. So what we want to do is take a benchmark average of those observations to see how far we are away from that average valuation. Okay, so that's what we're going to be doing in our examples. And then we're going to just look at another factor, are strikes. Because if you're doing a calendar spread, yes, you have to pick, you're picking two different expirations. But you have to also pick strikes, right? What strike are we looking at? And that could play into your outlook on where you think the stock will drift from now to that first expiration. So if you're bullish, you want to pick higher strikes. If you're bearish, you want to pick lower strikes. If you think the stock is going to sit here, you pick the strikes where the stock is currently at. And the reason for that is when you think of a calendar spread, well, we're short one option, and if the stock floats to that strike and sits there on that first expiration, well, that premium goes to zero, it becomes worthless, and you keep all the premium that you sold it for. However, the second option will now be at the money. Right now, that second option will be right at the money, and since it still has time premium, at the monies are where the time premium is the highest, because at that point, it's all time premium, right? Once it's at the money, it's all time premium. It's not intrinsic value, it's not out of the money, it's all time premium. So you want it, your best sweet spot scenario is that the stock goes to the strike that at that first expiration that you have that strategy on. Okay, so if you're bullish, you want to pick a higher strike where you think the stock will drift to. If you're bearish, you want to pick a lower strike. If you think the stock will be right here, then you'll pick a strike where the nearest strikes to the current stop price. And calendar spreads, they do have carry different risks. One is the directional risk, just like we talked about. You have a vega risk or implied volatility risk. If you're long the calendar spread, well, you're long vega. You want volatility, especially in this term structure, to move higher. You want that longer term option to move higher with higher implied volatility. You do have some gamma risk. So depending on kind of how you structure, but you do have some gamma risk there. You have some theta risk there because you have the decay risk. You have the way the term structure looks like. So if you're short one option, you're long the other, but if it goes against you, the term structure, that's another risk too. You also have a early exercise or assignment risk, and there, since you're short one option and an option that you're short could be in the money and it could get assigned, right? It could be for a dividend, or depending on what you have on, it could be for other reasons, but it's possible you get assigned on one of your short options, and that of course is always a risk in options trading. So now I think what we'll do is go to a screener with calendar spreads, and we're going to do some examples using different functions to screen them. Okay, so let's leave this slide deck, and I'm going to go here to a screener, and this screener, these are looking at calendar call spreads, a debit calendar call spread, because we're looking at a long calendar call spreads. So up here, we do see some filters here, and below we have this table, and this table screens out different potential calendar spreads, looks at the current markets, comes back with the market for this calendar spread, the price, then runs an analysis on it. So we could screen for calendar spreads with particular or unique factors, parameters, using our filters. So first, let's just read left to right. Here you could see the symbols Microsoft, and we see a bunch of Microsoft and Apple, and that's because we could structure different types of calendar spreads with different strikes. This is the stock price, today's change in market cap. And here we see this here is the market price. So if you buy this calendar spread on the markets, it's $3.50. And this is the calendar spread we're looking at here. So it's looking at the 470 strike, the June 20th call with 26 days to expiration, and then the July 18th call with 45. So they both have the same strike, 470, June 20th, July 25th, and you can see the days to expiration. So what's the cost of that strategy? $3.50. And how do we get a sense of if that's high or low? So we need some kind of a benchmark that we establish so we can start comparing these and see how far away it's from a benchmark. So the benchmark we use here is the average value of similar spreads in Microsoft. And that we have as $4.08. So you can see that this is below the historical average of $4.08. So in theory, it's, if we use that benchmark, it's a 16.7% theoretical edge. If we say that that's what its long-term value, that's what we treat as long-term value. Besides the average value, we could also look at the historic, because those values are changing, right? Sometimes it's lower, sometimes it's higher, sometimes it's right on or near there. So if we looked at our observations, we wanted to get a sense of how often is the term structure lined up that this would be worth more than this price or less. So this is the ibkr rank. And this is telling us that if we use the historical implied volatilities of similar options, looking at that term structure and similar strikes, distance away from spot price, this is saying that 14% of the historical observations would fall below $3.50 and the rest above. So this shows that right now the calendar spread is on the lower end of the historical range. It's priced at the lower end of the historical range. So let's just take a look at that. If we open that analysis, okay, here is how we got there. So you could see it's going back in history and doing a benchmark. It's using this weighted, similar to the VIX, doing this weighted average implied volatilities benchmark with the surrounding data and the surrounding expirations. And here it's going back in time and saying, well, on this particular date, similar option would be 17.2 implied vol versus 18.1. The date before that, it was 18.4 versus 19.8, 19.7 versus 21. So you could see here how they're changing and the relationships between the two. So then it's plugging that into the formula and coming up with a value for each day. And these are the historical observations. So if we plugged in the historical implied volatilities, these would be the different values. So that's doing it, that analysis for us on demand. And here we see that the average of all these values was $4.08. That's here in the brown, giving us a 50-cent theoretical edge based on the current price of $3.50. And this is the range on the low end to the high end. So right now it's $3.50. Historically, the lows we had was $3.21 versus a high of $5.25. So now by opening up, we kind of see like, okay, this particular setup right now is on the lower end of the historical range, priced at the lower end. Okay, not completely at the low end, but on the lower end. Close that. And this helps us with a couple things. If we're looking for similar situations like that, that could help us because we could screen for those scenarios. It could also indicate to us what the markets are signaling. So the markets are signaling that they think that the implied volatility difference and the implied volatility on the longer dated option will stay somewhat muted. And we could also look at similar scenarios, like comparing it to Apple or NVIDIA, or you could see Amazon, to see how those line up relative to Microsoft. Okay, so that it could be used as potential opportunities if you're looking for a specific scenario, or if you're just trying to figure out what are the markets themselves trying to indicate or signal. And when we screen for it, so let's come back up to the screener for now. When we screen, we need to define the expirations we want. And that's important because the first thing is, okay, I need to come up with the expiration I want to sell versus buy, right? And here we could choose that by dropping this down, picking an expiration, and then the further out expiration, we could drop this down and pick an expiration, and this will run a new data table looking at time spreads for those expirations that you chose. All right, but let's just stick on this one as our default. And we could also pick maybe out of the money options or at the money options. So let's say we're relatively bullish. We think the market maybe is now priced in a way where, like, okay, some of the uncertainty is gone, and we think that money's going to start flowing back into the market. Whatever. Let's just say our analysis is we're generally bullish on the market in the next X amount of days to that near-term expiration. So we can just pick strikes that are out of the money, higher strike calls. We pick that, and now we could see, for example, here's Microsoft. The stock's 447, but this is looking at the 470 strike or 465 strike. So it has a more of a bullish out now. Okay, same thing with NVIDIA, because now we're looking at higher strikes, out of the money strikes. So let's keep it at there for now. And we can screen based on that theoretical edge or percentile rank. We can do it that way, and this looks at the historical term structure and sees if we're priced on the lower or higher. So if we wanted to do it based on the theoretical edge, we could give it, like, let's say a 25%. You can see here, now it shows us where the current price is priced. The markets are priced on the lower end of the historical range, giving us a 29.7% theoretical edge. What about the percentile ranks? So keep in mind here, if you're looking for something relatively low price, cheap, then you're looking at a lower percent rank because you want most of your observations to be priced above that. So this is telling us 7% of our observations were priced below. Okay, so we could even give that maybe a below 20%. So you could see how quickly I'm narrowing things down. Now it's 24 stocks or 24 calendar spreads that met the conditions that we just talked about. I'm going to release these for now. And let's say we wanted to do it by volatility. So I'm going to click on the volatility here. And on this tab, so when you switch these tabs, you get a different data set. Okay. So by clicking on this volatility, now I have, I'm looking at different data. And I'm still looking at, so here's the near term, far term options. So it just repeats itself. So we know what we're referencing, the 470 strike on June 20th. It's a 21 delta. July 18th, 470 strike. This is a 30 delta. And what are the implied volatilities of these options? So the first one, the near term, you could see the bid and offer is 17.5, 17.6. So let's just say it's around 17.5. The further out one is 18.1 and 18.2. Okay, so you could see it kind of, this one increases as we go out in time. Here's one that decreases, NVIDIA. It's 47.48, while the further term one is 43.4, 43.6. So you see how they're the implied volatilities are different as we move across expirations. And let's say we're looking for a scenario where, I'll just make it up. Let's say we're looking for the further out option that is maybe, let's do below 70. Okay, so let's say the further one out is below 70. So you could see here far, these are all below 70. And let's see if any that we have the near term, maybe above 70. Let's see if any of those exist above 70. Okay, so we had a few. We had 4 of them. So you could see here XPEV. So the near term is above 70, while the further out term is 68. So they're close, but there's still, one is above 70, one's below. Here's X, this one, the nearer term, this June 20th. This particular option is around 74 implied vol, right? If we look at if we just look at the midpoint, while the further out option on July 18th is around 58. Okay, so that's one way to quickly, if you're looking at those types of scenarios, to try to filter out based on the differences in implied volatilities. One designated above a certain volatility, one designated below another volatility. So we found 4 of those scenarios. Now I'm going to let go of this for a second. And let's just get back to the original one, June 20th, July 18th. And if we wanted to quickly just reference the historical range, if we go to this ibkr, okay, now I'm on the ibkr, and here we see, here's a market price, and we wanted to see the historical range in a table, but here's the historical range, 316 to 522, with a median of 386, and this is using 102 observations, okay, historical observations. And if, so here we could see this one is 270 versus a historical range of 159, 304. So this is closer to the higher range. It's above that median, 225. Okay. And this explains how many out of the 102, how many of the observations were above the current market price. So 87%, 89, and 13 were below. Okay. So again, it's a quick way to start referencing and getting assessments of spreads and where they're priced at relative to its history. Another important thing is the potential payout. And I'm going to click on this really quickly. And when we look at options and we look at strategies, well, we're also thinking, yes, valuation is important, but also what's the potential risk and reward? I know how much I'm risking, but what is my potential reward there if things go my way? And if they don't go my way? And in a calendar spread, when you're long a calendar spread, you have some risk, but typically you think of it as what you paid for. Of course, there's risk of early exercise and stuff, but that you have to consider. But typically you're thinking about it as your risk is what you paid for it, and how much can I potentially make at expiration. Remember, we're talking about the first expiration. So to draw a couple scenarios, we look at this. If the stock price is at the strike, like our best case scenario, remember that the stock just floats to where the strike price is, then that first option expires worthless. We have this second option. We don't know what the second option will be. We have to estimate it. So to estimate it, we have to plug in an implied volatility. To plug in implied volatility, we're going to look at historical potentials, and we'll say this: if the implied volatility is on the lower end, 25th percentile, right? What would this spread be worth? 1039, so that would be a 205% return. If it's on the 50th percentile, it's a 226% potential return, because that option will be worth 1111. If it's goes our way to the 75th percentile, meaning that the implied volatilities do increase, right? The implied volatility for that option at expiration will increase, and it'll be in its 75th percentile rank. Well, then that option that doesn't expire will be worth $12.26, which is a 260% return, right? So if you're going from 340 to 1226, it's 260% return. So that's if the stock goes to the strike. What if the stock is flat? So maybe the stock it just stays right here. So we could run the same scenario if the stock is flat. If the implied volatility is at the 25th percentile, then you lose 31%, because then this strategy will be worth 233 versus 340. If it's in the 50th percentile rank, the strategy, that option remains worth 277, an 18% return. If it goes to the 75th percentile rank, then it's a gain. It goes up to 351. So here, it's something to think about, where you're like, is it worth, the risk I'm worth, what am I risking here? If I'm doing it 340 to potentially what I can make, and here, potential, we see over 200% return if things go our way. And we could screen for those types of potentials too. Let's say we come up here and we say, what type of potential payout am I looking for if the stock does go to my strike? Let's say it does go to my strike, but the implied volatility drops to the 25th percentile rank. So so the stock floats in my favor, but the implied volatility not necessarily. What will happen if it's in the 25th percentile? But I'm looking for still a decent return, let's say above 50%. So click on that. So here we go. So even in Microsoft, if the stock goes our way and it goes to the strike, even if the implied volatility is sitting at that 25th percentile rank, we're still looking at a 200% potential return. So those are different ways to screen calendar spreads when we're looking at valuations, potential risks and rewards and biases, based on direction. We could use these filters to keep narrowing things down. And then, of course, we would want to go and always, analyze things further, because each stock is unique and you have other factors involved in dynamics such as news and events and all those other things that you have to take into consideration. This is a way to narrow down those candidates quickly. So I think that we have less than 20 minutes now. I'm going to take questions.
AD, the camera's working now, so that's nice. Everyone can see my less than beautiful face. The first question's from Eunice, who's asking, what's the term structure risk? Can you please explain?
Yeah, so the term structure risk involves the difference in implied volatility in the expiration. So let's go over here. And here we're looking at the two expirations here in Microsoft. You have a June expiration and a July. So the June expiration, you're going to be, if you're selling that option, right, you're selling it with an implied volatility of 17.4. The July 18th expiration, if you're buying it, an implied volatility of 18.2, let's say. So you could see that now you have this term structure where what you want to happen is for the slope to steepen, right? You want the slope now to move higher as you go out further in time, because now your far out option, right, that your July option goes out further in time, so you want that slope to increase. So you want these options that you're short to be relatively lower than the ones that you're long. So let's say this drops to 15 and this goes up to 19. Well, that's good for you, because the options that you're short are decreasing in value. The ones that you're long are increasing in value if implied volatility goes up. So on a relative basis, you're skewed. The skew in the term structure is going your way. But what if it doesn't? What if these actually start going up? So you're short and these go, like, say, to 25, and then the ones you're long fall to 15. That's not good for you, because the implied volatility is going down in the options you're long, so your options are decreasing in value. And if the implied volatility is going up in the options you're short, those options on a relative basis are increasing. So you have this risk that the term structure changes, but it could change and shift against your position, right? That's how it is. It could shift in a way where your long options are decreasing while your short options are increasing. So if you're long a calendar spread, you want that to start sloping higher. Even if these increase, right? Even if, let's say, these go to 20 and these go to 25, well, that's good for you as well, because yes, you're losing on one, the implied volatility increase, but you're gaining even more on the one that you're long, because the slope got steeper. But if it goes the other way, then it's not good for you. And that's the risk.
Perfect. Sanjay's asking, can we change the number of days to calculate a historical IV?
Well, you could change the expirations here. So this is looking at actual expirations available to trade. So it's not by days. This automatically changes the days. So let's just say we're looking at an option, I don't know, What do I have here? June 20th. So let's just say we look at an option. What's the next May expiration? 23rd, something like that. So 10 days to expiration. So you could see now I have May 23rd. Let me see. So we have May 23rd with 8 days to go versus July 18th, 45 days. So this is looking at the actual expirations available. So, you know, because if you pick days, those options may not even exist. Keep in mind, like the expirations that are available to trade aren't for, you know, we don't have an option for every single day from now to you know, going out forever. They're just, you know, certain expirations available to trade, and that's what this is looking for. So tomorrow, this expiration, you know, we'll have 7 days, then the next day 6 days, and you know, and so forth.
All right, perfect.
You can change the expirations. Yeah, you can change the expirations that you're looking at from here.
Hi, Dimitri. Are we able to filter the options change to show only high volume and high IVR, for example, as a baseline filter?
Wait, read that one more time, James. I mean,
hi, Dimitri. And this he's looking at the options change, I guess. I don't know if you want to get into it, but hi, Dimitri. Are we able to filter the options change to show only high volume and high IV, for example, as a baseline filter?
So I'm assuming when he says options change, he's just like looking at these particular strategy setups.
We'll go with that.
Yeah, that's what I'm assuming. So if you wanted to say look for just high volume stocks or even high IV, you can change the IV here. You know, like you could just above a certain amount or below a certain amount. And you could certainly use the IVs from one to other. But if you wanted to, let's say, have more parameters like high volume or unusual volume, what you could do is go to the stock screener. In the stock screener, you have a lot of more filters that you can do that. Set those filters and save it. All right, let's just say we save it with high volume. We'll call it high volume, high IV. You give it a name, and then once you save it, you could come back here, and then you could use that stock screener here. So you can, whatever you save, select it, right? Like here, I have stocks in an uptrend. If I select it, I've saved this in my stock screener, and now, you know, it's showing me stocks that I saved that I defined are currently in an uptrend. Okay, so this is using a screener within a screen. Okay, it's like you doubling up on your screeners. So you can do that by going to screeners, stocks like this. Here, I'll show you really quick. I'm in the stock screener, right? So now I have all these other filters, and here, let's just say I did, what was like average, let's say option volume, let's say, you know, above 20,000, relative volume, whatever, above 5. You could set all this here, you know, and then just save this screener, give it a name here, save it. Once you're saved it, you could go back to this and retrieve it. Okay, so that's the way to do that.
All right. Next one is, are volume histograms available?
A volume histogram?
Yeah.
I'm not sure what a volume histogram would be. We do have different charts that break down volume, but that's kind of outside the scope of the calendar spread. So, that might involve an entire different webinar almost just to go through it. But I'm not sure, like when you say histogram, what is the histogram charting? Like, what are you trying to display in the histogram?
All right, well,
Because when you think about, look, options volume, you could plot calls versus puts, you could plot volume by delta, you could plot volume by expirations, you could so there's different ways to chop up and plot and graph options volume. So you'd have to kind of like define what you're trying to visualize.
so Stephanie, if you want to email Dimitri directly with maybe your question, you can email support@marketchameleon.com and tell him what you're trying to graph, and he could get back to you and let you know if it's something we have. Dan's asking, can you toggle the number of observations to obtain a more robust number of observations?
I think when what you're referring to is the number of observations in the screener, right? Like these observations that are available. So you can't toggle this from, let me just make sure. Yeah, so you cannot change or toggle this from the screener. The screener are just defaulted to what we have, but if you're interested in this spread, one way to do it is, because it's something to narrow down things, right? So you're trying to narrow down. But once you narrowed it down to what you like, if you go to the options chain and set this up, let's just click on this. So once you go to the options chain, like if you click on it, you see here, it'll set up this strategy. So this is the same legs that we just analyzed. If you run your analysis, okay, so now we have this theoretical value again with the range. And let's come to the ibkr. Okay, you go here in the ibkr. I know it's deep in here, but go to the settings, and here, okay, you could start to play around with the number of observations. So we have it by number of years. So 1 year, 2 years, 3 years, this way. Okay, so we just have it set how far back you want to go.
All right, perfect. Ningchu is asking, do you have any recommendations on how to select the expiration dates? What criteria would you look for?
That really depends on your forward-looking outlook, because it changes, right? There's no like set, you have to look for this date and this date. It depends on your outlook. But for example, let's say you read the news and and there's an announcement that we're going to announce tariffs in 2 months, right? So if nothing changes in 2 months, we're going to have tariffs. Well, if your outlook is, well, if that happens, I want to own volatility more than 2 months from now, because the markets are going to, become more volatile. There's uncertainty. But up to then, we're not going to, there's not, until we get there, the markets, don't have that uncertainty. So based on that, you might want to do something that straddles that particular time, those dates, right? Another way is, well, we're in a high volatility environment, and I think the implied volatility will stay high for next month. So I'll get an option that goes out a month, but I think after that month, we're going to drop off and it's going to go down. The uncertainty will be gone. This volatility is not sustainable. Maybe maybe it'll be sustainable for another month, but not longer than that. Well, then you go out further, and if the term structure lines up favorably, you could do a short time spread. So when we look at it, your outlook is changing based on the information that's coming out, your assessment of that information, and your belief in what is more likely to happen or what you think will happen, and then you compare it to the markets and see if like they disagree or agree with you, or they're out of line based on that perspective that you created. Like maybe you could look for strategies around earnings. You have two options, that one straddles earnings that it will cover earnings, the other won't, or the other way around. So it will depend on many factors, especially, markets are dynamic, so you have to kind of keep, what if there's a Fed meeting, right? What if there's a Fed meeting and you think that this Fed meeting will be particularly volatile, or something might happen where, the people are expecting that interest rates will be the same, but you have you have a higher probability of a change in an interest rate, so you might want to get an option that will cover that Fed meeting against an option that doesn't cover that Fed meeting. So those are always factors to consider when you're setting these things up.
All right. I think we're right up against the hour. There was one last question. Well, we had two. Are indices like SPX, NDX, and RUT included in the data set?
Not right now, no.
All right. And we had, maybe Jeff, you can answer this one about, is this available with IB?
Yeah, so again, you can subscribe to Market Chameleon's services through our platform. I believe you get a month free if you go through us. So while it's not an IB tool, it's certainly you're able to subscribe to it, and would recommend, if you are interested in it, you would get that month free by going through our platform to get it.
Yeah, exactly. So if you go through ibkr, there's a way just to get, I guess, I forget, look a token or something where you can subscribe to it, and then you get an entire month for free to try it out.
Perfect. Well, we're right up against the hour. There were a bunch of other questions about people referring to this as some sort of AI, Chameleon AI. This is just a screener. There's no AI, but it is going through our data and analyzing it. So if anyone who has questions that we didn't get to, you can come over. We have a free morning show every morning, combination show webinar, and that's at 9 o'clock every morning on our YouTube channel, marketchameleon.com. Just give us a search on YouTube. And you can always email support@marketchameleon with any questions you have. Thanks for having us, Jeff.
Oh, my pleasure. Love our monthly webinar. And again, you can find more great material from Market Chameleon on our website. Go to interactivebrokers.com, click on education, look for contributors, look for Market Chameleon, or go to podcasts or webinars, and you'll see all the great material. And looking forward to seeing you guys in the studio in a little bit. And for our people at the webinar, keep an eye out for our podcast coming out on this subject as well. Should be out, like I said, most likely midday Thursday. And that's it, guys. Enjoy the rest of the day.
Thanks everyone for joining. Have a great day. Thanks, Jeff. Thanks, IB.
Thanks, Will. Thanks, Dimitri.
Bye, everyone.